Good evening, everybody. Welcome to our investor awareness program. Today, our topic of discussion in the program will be our product good in English, which is known as jaggery. So, before I begin the session, so if any of you have any queries during the session, please post your queries in the Q&A section. And during the session, you will be on the listen and view mode only. So there are any queries, please post them in the Q&A question. I will be happy to take them at the end of the session. I hope the presentation is visible to everybody. So before we start the session on the product, which is good, I'll just give you a brief on the commodity derivatives ecosystem. So, the commodity derivatives ecosystem, the evolution of the commodity derivatives market, it basically dates back to the 19th century when the Bombay Cotton Trade Association was established, and following which we have seen many other commodity specific, region specific commodity exchanges being established. Uh, Focusing on individual commodities, like you had mustard seed exchange, then you had castor exchange, you had turmeric exchange, then raw jute exchange. They had all flourished during the 1910 and 1930 period. And then to regulate these commodity exchanges, the regional exchanges, FMC was established in 1953, which was the Forward Markets Commission back then. And later, after the commodity, the FMC was established, there were regular bans that were taking place in the products that were launched, and the futures trading, basically the derivatives, was being banned because the supply demand fundamentals back then, we were falling short of, we were we had a shortage of uh, production. Basically, there was a supply problem then, back then. So to control that, there were a lot of bans which had taken place in the later half of the 20th century. And the government of India also extended the list of commodities. After this ban, there were a lot of committees which were formed, which had analyzed and tried to study and understand the derivatives market and their impact on agricultural commodities. And later that, the government of India extended the list of commodities for which trading could be allowed in 2001, following which most of these national commodity exchanges had started operations in 2003. And it's been continuing since 2003. All the exchanges are operational, though there have been a lot of changes that have taken place, especially after our present regulator, which is the Securities Exchange Board of India, SEBI, which has taken over in September 2015, and FMC has also merged absorbed into SEBI. So this is because it is a regulatory setup, and this is how the exchanges function basically. So they are under the Ministry of Finance, the Department of Economic Affairs. Under that, SEBI is there, which is the Securities Exchange Board of India, and all the national exchanges report are regulated by SEBI. So as on date, we have five major exchanges, which are NCDX, MCX, ICX, NSE, and BSE. And when we talk about commodities, there are about 91 commodities that are permitted for trading in the derivatives market as per the SCRA Act. Like I said, there have been a lot of changes that have taken place in the commodities market uh, over the years since their operations began in 2003. First and foremost is most of the regional exchanges or the commodity exchanges. They have, a lot of integration has taken place across, and In 2017 June, SEBI permitted options in commodity derivatives segment, and followed by Category 3 AIFs, alternate investment funds, were also allowed in June 2017. Post that, it had announced integration of the commodity arms of commodity and equity arms of broking. So earlier there were commodity exchanges and equity exchanges, and they were supposed to be regulated, or the businesses were two different arms. But now they have all been merged into one. So a member or a broker can operate in both commodity and equity under one. Under one license, basically one registration. And bank subsidiaries are also allowed to distribute commodity derivative products, and banks are also permitted to participate as professional clearing members. And come to 2018 September, FPIs, or foreign portfolio investors, are also permitted to hedge their exposure in the Indian commodities, in the Indian physical markets, basically. So they will be known as eligible foreign entities, and there are certain guidelines for them to participate in the Indian commodity markets. Basically, they are people who have exposure in the Indian markets, in the Indian commodity markets, physical markets. And later in the year 2019, mutual funds and PMS, which is portfolio management services, have also been allowed to participate in the commodity segment, commodity derivatives. And in June 2019, finally, the much awaited product, which is the indices, have also been allowed, given permission to be traded on commodities. These are some of the commodities, agriculture commodities, that are currently being traded on the exchanges. So basically, they represent different commodity baskets. We have cereals and pulses, which have bajra, barley, chana, maize, wheat, moong, and paddy. Spices, coriander, jeera, and turmeric. Fibers, we have cottonseed oil cake and cotton, Shankar Kapas, which is raw cotton, and the 29 cotton. Then we have the GUR complex, which is guar seed and guar gum. And then we have oil and oil seeds, which is soybean, refined soy oil, mustard seed, castor seed, CPO, crude palm oil, and sesame seed, which was launched very recently. Uh, there are some basic differences between the commodity and financial derivative markets. So we'll see what those are. Though the differences are basic, but they are actually play a major role in commodity derivatives and financial derivatives. So in commodity derivatives, the settlement is actually by actual deliveries, because there's a commodity which is involved, which is physical in nature, and there are quantity and quality differences that exist with that physical commodity. And definitely, when the commodity is physical in nature and you're storing it, there is a holding cost, the carry cost, which includes the assaying cost, that is cost of testing, then the warehousing for storage, and the insurance costs that come with it. So all these costs are involved in the commodity derivatives market. And again, for agri commodities especially, the physical markets are very seasonal in nature, because we understand there's a kharif season, there's a rabi season, and they're produced during a particular season, and there's the demand is spread out throughout the year. So hence they are very seasonal in nature. And the commodity derivatives are mostly impacted by factors like the demand and supply of that commodity, the import and export regulations, and the government interventions, basically. On the other hand, financial derivatives, they're only cash settled, and there is no such differences as the quantity and quality. And the holding cost only basically involves the interest costs. And the financial derivatives are perennial in nature, because they are active throughout the year. There is no season that defines their availability at a particular period of time. And the factors that basically impact the financial derivatives are the global and local economic conditions, performance of the entity, and the taxation structure. So now we come to our focus product, which is good good is jaggery, and though it's not still available for trading on the exchange, we are soon going to be launching this product for futures trading. uh, so like we just saw in the previous slide, uh, to understand a commodity derivative or commodity futures contracts are defined or are studied basis their production, their supply demand, their supply demand, their availability, seasonality, uh, export import policies, government interventions. So to invest in any product, it's very important to understand these factors, and thus we will look at what are the important uh, uh, parameters for this commodity, which is good. Going further, how the production and seasonality of this commodity is. Yeah. So when we talk about good jaggery, India is the largest producer in the world, and it produces nearly about 60% of the total global production. So global production is somewhere close to 13.6 million metric ton, and this is data that is available as per the USDA, and it's only for 2018. That's the latest available data. And because good is a byproduct of sugar, we do not readily have 1920 data available. But basis 1819, we can see that India is the largest producer, producing nearly about 60% of the total global production. And globally, Brazil is the major exporter of jaggery in the world. We know Brazil is one of the other largest producer of sugar. So, and USA, China, Indonesia are the largest importers of jaggery in the world. When we look at goods production from the Indian perspective, then in India, the production of good has been seeing a very huge increase. When you look at the numbers on the screen, 1718 to 1819, it's almost close to 40% increase. Wherein in 1718 the production was 4.5 million metric ton, and in 1819 it is 18.17 million metric ton. And in India, the top producing states are Uttar Pradesh 47%, Maharashtra 21%. Karnataka 8% and Tamil Nadu 5%. So these states together combined produce more than 80% of the total jaggery production in India. So good again. It's a basically it's a byproduct of the sugar cane. So its harvest is closely related to the sugar harvest. So the overall the sugar season in India starts, basically the harvest starts from October, November onwards till March, April. So with the harvest of the sugar cane is the cane, the good also, the good processing also takes place. And when we look at the arrivals state wise, we can see that Uttar Pradesh has been constantly standing out in the last 6 years, wherein it's the largest state. We have seen even in the earlier slide, wherein 47% is contributed from Uttar Pradesh. And the arrivals also from 2013-14 to 18-19, we see that Uttar Pradesh is the largest contributor constantly, and closely followed by Maharashtra. Uh, to understand any it's very important for any derivative contract to have a larger participation, because larger participation brings larger liquidity to the contract. And thus it's very important to understand the value chain. And the value chain for good, like all other agri commodities, involves your farmer, followed by the aggregators or the commission agents, traders, then the processors, and ultimately the consumers or the retailers. So the farmer is more involved in the production, harvesting, and storage of the good, and aggregators and the commission agents are more into transportation and adding value by storing the goods, which, if the farmer cannot hold it for a longer duration, the traders, the stockists, do that on behalf, and then that is how they add value. And the processors who purchase from the aggregators or the commission agents later process it as per different, grades or sizes, and packaging and labeling is what they do, and ultimately it goes into the market through the retailers, uh, institutional sellers, etc. So this way you can see that a large number of people are involved in the value chain of good, and there is a risk for every participant at each stage of the value chain. And thus to mitigate these risks, because there is a price fluctuation that takes place, to mitigate these to mitigate these risks, we have we are planning to launch the futures contract in good. uh, so basically, when we've studied the price of good, we've seen that it was highly volatile, and this volatility asks for a reliable mechanism basically to mitigate the risk arising out of this price fluctuation. And we've also seen that the production of good in India is being, it's on a continuous growth path. Well, a considerable amount of this total production is also used as a feed, and this will have a considerable impact on the overall feed cost. And the basis of the availability of the product, that is on the huge production, production is also one of the factor for a commodity to have futures market. In that, the larger the production, larger the participation, so that will increase the participation and the liquidity in the contract. And considering these factors, we do not see any hindrance for introduction of this commodity in the futures market. Like I said, there is volatility in the prices. So when we talk about volatility, mostly anything more than 10 to 12% is considered a highly volatile product. So when we've analyzed this, so in 1617 the volatility analyzed vol was around 17.5%. In 1718 it was 19.2%, and likewise in 1819 also it was 19.2%. So, after understanding and studying the basic supply demand fundamentals of the product, the contract is being designed keeping those fundamentals in view. So, when we talk about the basis center for good futures, Muzaffarnagar, which is in Uttar Pradesh, uh, has been proposed as the basis center because we've seen in the earlier slides as well. Uttar Pradesh is the largest good producing state in the country, and it's a big production center with the presence of many processing units. Because of these processing units, there's availability of good infrastructure support, and in the entire market, it is considered to be the benchmark center for good. So these are the contract specifications. The unit of trading would be 10 metric ton, and the delivery unit would be 10 metric ton. The quotation or the base value, the price quote would be taken for rupees 40 per kg. The tick size is 0.50, and the quantity variation for deliverable for delivery is about +2 - 5%. And the basis would be ex cold storage warehouse, Muzaffarnagar, and it's going to be inclusive of all the local taxes, exclusive of GST. The delivery logic will be compulsory delivery, and the delivery specification, all the contracts would be on the all upon the expiry of the contract, all the outstanding open positions shall result in compulsory delivery, and the due date would be 20th day of the delivery month, like all our other products. So this is the quality specifications for good feed grade futures contract. Sucrose would be around 75 to 80% minimum. Reducing sugars would be 10 to 15% max. Moisture 10%. Sulfur dioxide 150 ppm max. Water insoluble matter 1.5% max. Sulfated ash 3.5% max, and ash insoluble in dilute hydrochloric acid 0.3% max. 100% dry golden brown cane good of chaku type. That's the variety that we're talking about, which will be which meets the above said mentioned specifications will be allowed for delivery at Muzaffarnagar, and 100% dry cane good of Balti type shall be deliverable at Hapur. So this is the launch calendar. Like I said, we are awaiting to launch it. We should be launching it anytime soon. So in the month of December, the contracts that will be available for expiry would be Jan, Feb, March, April, May, June, and post that. Sorry, there's an error there. January 2021 got repeated, and post that. So basically, all the 12 contracts will be available for trading. uh, Along with understanding uh, uh, the commodity fundamentals, it's also important as an investor to follow certain do's and don'ts. So these are certain do's for the investors. That is, you have to read SEBI exchange circulars available on the exchange website, trade only through exchange registered members, fill KYC mandate, unique client code, insist on rights and obligations and risk disclosure documents statements, insist on bill contract notes for every settlement, ensure that the contract note contains all relevant information such as basically your member registration number, then your order details, your trade number, trade quantity, trade rate, and the arbitration clause. And always cross check trade genuineness through exchange verification facility, which is available on the exchange websites. You have to pay the required margin, failing which, and M2M obligation, failing which there will be some consequences for non-payment. And beware of risks associated with the dabba trading. You always reconcile the statement of transactions that you receive from the member and the holding statement of the depository participant post every transaction. In case of any discrepancy, please voice the same immediately, and issue account pay check demand draft in the name of the broker member as it appears on the contract CB registration certificate. Insist on periodical statements of accounts of funds and securities from the broker. Check accounts and notify brokers of any discrepancies. Funding from unauthorized intermediaries aren't covered under settlement guarantee exchange mechanism of the exchange, so beware. Investor guidelines don't deal with unregistered intermediaries. The list of members is available on the exchange website. And don't undertake off market transactions. Don't get carried away by alluring advertisements, rumors, hot tips, etc. in promise of assured returns, because you should always do your own due diligence on the product and only then invest. Don't start trading before understanding the risk disclosure clause. Don't accept unsigned duplicate contract notes, and do not fall prey to market rumors. Don't let the risk against positions accumulate beyond your capacity to bear. Just don't let the risk accumulate beyond your capacity, and don't simply go by and any explicit implicit promise made by the analysts, advisors, and experts. Like I said, always do your own due diligence. Don't mess on keeping track of your financial and contractual obligations against your positions, because there will be consequences for non-payment. And don't go by the reports predictions made by various print and electronic media. So that's all from my side. Thank you so much. If there are any queries, I'll be happy to take them. So there are some questions. Uh, I'm a farmer, so how can I hedge my position for getting better prices? So for a farmer, we have a special program that we are specially focusing and running on, basically because, like you have seen, our contract size is 10 metric ton. So basically, we have provisions for an FPO, which is Farmer Producer Organization. As an FPO, we have a lot of programs and benefits that we're running for the FPOs, wherein first you need to aggregate the required quantity as an FPO, which is 10 metric ton. And once you have that, you sell that material, you hedge your position uh, against that quantity on the exchange. That is, you sell the futures contract because you have the physical in your hand, the physical material, and that way you're locking in your price. And to deposit that on the exchange, we will be doing, especially we will be helping you. So if you can leave your number in the chat, I will get back to you once the session is over and understand what your requirements are, where are you based at, and how we can help you further. Uh, what benefits can a trader be reaped from commodity exchanges over the usual APMC, mandis, auctions, as trader needs same cost when carried out in mandis? So basically, the function of futures market is price discovery and price risk management. The mandi auctions will be there because the physical markets are not going anywhere. Physical markets will be there. Commodity exchanges help you in managing your price risk. So if I am a buyer and I need to buy, say, 2000 metric ton of maize every month. Okay. So when I start buying that quantity in the physical market, the price starts increasing because as a buyer, my quantity is huge, everybody knows. So, but when I purchase the same on the commodity exchange, that is hedging, when I purchase the same on the commodity exchange, 2000 metric ton, I am I am undisclosed. Nobody knows who is the buyer, and I get my quantity at the price that I want and at a by paying just a margin of 10% on the value of the commodity. Unlike in the physical market, you pay the entire 100% and your capital is blocked. Good is, yeah, my bad, sir. It is a product of sugarcane, not a byproduct, but a product of sugarcane. Like sugar, we have good. Sir, if you can share your number as well, Mr. Gajanan, I will call you back. Any more questions, please? कॉन्टैक्ट इस कार्य को आरंभ हो रहा है। सर ये हफ्ते में आ जाएगा सर सर्कुलर मोस्टली, और जो पहला कॉन्ट्रैक्ट रहेगा वो जनवरी का रहेगा। If there are no more questions, we can end. I am one farmer's a benefit in NCDs. Thank you so much, sir, Mr. Dhyaneshwar ji. फाइन कोई और क्वेश्चन नहीं है तो आई end the session. I once again thank you all for attending today's session on investor awareness program on GUR. Thank you so much. Have a good evening.